Hello everyone, this is Ricey and welcome to my channel, The Quest for Wealth.
Our stock valuation of TD Bank is divided into three parts. The first part is the background of the company. We have to identify how large the company is and how stable its operations in Canada and globally. The second part is the financial health of TD Bank, if the company is growing and if the management is employing its assets to efficiently grow the company. And the third part is to compare the stock price of TD Bank to Royal Bank of Canada and make an informed decision on which stock is a better buy. This decision will be primarily based on the financial health, growth, and which stock has a closer price to its intrinsic value. TD Bank is one of the two largest banks in Canada by assets and one of six that collectively hold roughly 90% of the nation's banking deposits. The bank derives approximately 55% of its revenue from Canada and 35% from the United States. If Royal Bank of Canada is Canada's biggest bank in terms of market capitalization, TD Bank is Canada's biggest bank when it comes to total assets. Here's the comparison of the total assets in 2020 of TD Bank, Royal Bank of Canada, Bank of Nova Scotia, Bank of Montreal, and CIBC. You will see here this is in billion Canadian dollars. And these three banks here are the three biggest banks in Canada. So the biggest one is the Royal Bank Canada, and then Toronto Dominion Bank, and then the Bank of Nova Scotia. TD manages $412 billion worth of assets back in 2020, and the net worth of the company as of July 2nd, 2021 is at $128.5 billion. Let us now head over to macro trends here in the financials of the company. The debt to equity ratio is an important factor that we have to look at. From 2016 to 2020, around 2. The acceptable figure here is 2 and below. The debt to equity ratio actually differs from industry to industry, but in general, it should be 2 and below. And if you will see here from 2015, in the last 5-6 years, the company has been growing its debt to equity ratio. And then right now from 2019 to 2020, it has been depleting. This is a good sign though, because the company is lowering its debt to equity ratio. Therefore, it is employing its equity more than debt in order to expand the company.
But if you compare this debt to equity ratio with Royal Bank of Canada, the Royal Bank of Canada's debt to equity ratio has been hovering from 2016 from 1.7 and it grew all the way to 3.4. And the Royal Bank of Canada has been over the debt to equity ratio acceptable figure from 2017 until 2020. This is for 3 years. The Toronto Dominion Bank is just hovering around 2. The highest that they went is at 2.9 back in 2018, but then they went back to 2.4 in the year ended, or the fiscal year ended 2020. This therefore means that the Royal Bank of Canada is taking more debt and is more leveraged when it comes to growing the company, and the Toronto Dominion Bank is taking on less leverage as compared to the Royal Bank of Canada. Let us go deeper, a mile deep into the financials of the company. We are now at macrotrends.net, and this is the income statement of the company. There are three major figures that we have to look at. That's the revenue of the company, the net income, and the EPS, or the earnings per share. The revenue, what we want to see is consistent growth in the revenue of the company. We want to see that growth in the net income of the company. We want to see that percentage growth trickle down in the net income, because if we did not see that percentage growth, then it means that the company is also increasing its expenses faster than it gains or takes in revenue. And note that this is in millions of dollars. So then this means that this is read at $24,465 million. The way that financials work is that in financial statements expressed in millions, multiply the number by 1 million. The reason behind this is because the company wants to shave off so many zeros. So in 2010, the company gained or had a revenue of $24,465 million, and it grew from year on year. So 2013, it is 3 billion higher than 2012, and then it slightly went under in 2014. It was only in 2017 that the company was able to overcome the revenue it had in 2012. So that's a good 5 years that it actually did not reach the 2013 gains. But then in 2018, it went over. It was a record of 41 billion, and in 2020 it was slightly lower. Well, not necessarily slightly lower, because it was almost 45 billion in 2019, and in 2020 it was 40 billion. So there is a difference of about 5 billion, and that's quite a number. Net income, what we see here is positive net income. Looking down here, we will find, if you will compare 2014 and 2013, in 2013, the company's revenue was 33 billion, and in 2014, it was lower at 31 billion. But if you have a look at the net income of these 2 years, the net income in 2014 was higher than in 2013, even though the company earned much more in 2013. So this is a good figure here. In 2015, if you will have a look, the company earned 30 billion and the net income was at 6 billion. This is almost comparable to 2013, wherein the company earned much more. It's more than 3 billion more than 2015, but the net income was almost the same as what they had in 2015. So therefore, the company's expenses are actually depleting, and therefore we are seeing more or higher figures on the net income. And even more of a comparison here, if we compare 2020 to 2019, in company's revenue was 44 billion, almost 45 billion. And in 2020, it is at 40 billion. So that's almost 4.5 billion difference. But if you will have a look here in the net income, the difference on their net income is very little. Companies' expenses are thoroughly managed, thereby creating higher net income to the company. The earnings per share is the revenue of the company, the net income of the company divided by the outstanding shares. In this case, what we want to see again is the growth in the earnings per share. If we look in 2010, it has been growing as well steadily, and even in 2013. That is a huge growth that is almost double from 2012. 2013 was the highest earnings per share that the company recorded, and the company did not reach that figure yet, or that pinnacle yet. In the fiscal year ended 2020 in October, the company hovered around 4.78. The good thing here is that the company is increasing its earnings per share, although it did not reach the pinnacle of its earnings per share yet back in 2013. Nevertheless, the company is growing. Now, let us compare the earnings per share of the company with Royal Bank of Canada. As you can see here, the earnings per share of Royal Bank of Canada is much higher than TD Bank. The balance sheet is the next statement that we have to look at, and what's important here are the three things: the total assets, the total liabilities, and the shareholder equity. The total assets minus total liabilities is the shareholder equity. What we want to see in the total assets is the increase of the total assets year on year, and this is exactly what we are seeing here from 2010 until 2020. There had been a continuous, consistent increase or growth on the total assets of the company, and liabilities normally would grow as well. But what we want to see is that the liabilities grows slower than the total assets, or the total assets grows faster than the total liabilities. And here, the total liabilities is growing, that's for sure. And if we have a look at the shareholder equity, is growing as well. And the shareholder equity is actually growing faster than the total liabilities. If now looking at the cash flow statement, what we want to see here is that now we want the cash flow from operating activities to be higher than the net income. And in this case, if we go through and take a look from 2010, the cash flow from operating activities of the company is actually lower than the net income, and even worse in 2011. They did not earn anything from operating activities. These guys are just burning cash. And even, well, in 2012, it was double almost. And the same in 2013. 2014 is a good one. The operating income were higher than the net income. 2011 was really bad because they lost money there. In the last 5 years, in 2015, it was absolutely higher, almost 4 times. And the same in 2016, 2017, 2018 was bad because in 2018, the net income of the company was 11 billion and they only earned from the operating activities 4 billion. So that's a deficit of about 7 billion. And even worse in 2019. Wow, it's only 203 million. Whereas the net income was 10 billion. Cash flow from investing activities, these are the investments of the company, how the company employs its assets and its cash to earn on investments. And if we compare this with the cash flow of Royal Bank Canada, in 2010, actually, the company has had a good operating activities cash flow. It has been higher than the net income, except for 2012. And the rest of the years, actually, they had been good. Whereas with TD Bank, there were multiple years that the operating activities were actually lower than the net income. If the operating activities are lower than the net income, then that means that the company is taking on debt to pay for its activities. The net cash flow should be a positive figure. We want this to be positive so that we know that the company has got cash flow to sustain its operations. And so far, except for 2014, it had been positive and it has been growing. Actually, there are some years that it can be choppy. For example, in 2017, where it was lower than 2016, and it was absolutely choppy. And then come 2018, there was a huge jump there. Yeah, normally when this happens, it's because of the investments and payments of debts of the company, and the reason that there would be effect on the net cash flow. The good thing about it is that they went positive and they have not gone negative on cash flow here for the last 5 years. So those are the key financial statements of the company. Having read these income statements here, the income statement, the balance sheet, and the cash flow, we could make a very quick decision here that the company is, yes, growing. It is turning in profit, but it is taking on debt as well. Now, going back to Morningstar, we now have to look at the PB ratio of the company. The PB ratio, again, the acceptable figure is 3 or under 3. In this case, it is 1.68. It is actually lower than the PB ratio of Royal Bank of Canada. The PE ratio of Toronto Dominion Bank is 10.66. It is lower, again, than the Royal Bank of Canada. 10.66 PE ratio means that the stock of the company is 10.66 higher than its earnings. And 10.66 is generally acceptable. The minimum or the average acceptable figure on PE ratio is 15. So this number is a good number. In this table here, you will see the details of the 11-year growth rate of the TD Bank. And the book value per share, as you can see here from 2010 until 2020, has grown tremendously. Growth is consistent. Let us have a look at the return on equity. Again, for the return on equity, what we are looking for is minimum 15%. It has been hovering between 12 and 15%. This is the Royal Bank of Canada return on equity. You will see that their return on equity is much higher than the TD Bank. They hover minimum at 15% up to 18%, which is the trailing 12 months. But if we base it until fiscal year ended 2020, it was at 14.2. It never went down from 14.2. That is the lowest it has ever recorded its return on equity. Whereas with TD Bank, they were only hovering between 12 and 16%. Now the ROIC, if we have a look here, this is again the Royal Bank of Canada. The ROIC, on general, the acceptable figure is 2%, and it is a home run with the Royal Bank of Canada. The TD Bank ROIC, or return on invested capital, is also acceptable. This is the ROIC of TD Bank. It is also acceptable, although it is lower than the Royal Bank of Canada. Nevertheless, it is within that acceptable average return. The debt of the company is equivalent to 3.96 years earnings of the company. So that's almost 4 years. 4 years is not bad.
TD Bank is indeed a financially healthy company as well. It is turning a profit. Yes, it does make use of leverage and debt to grow its business. And the main point that I wanted to make is that at less than $100 a share, TD Bank really does make a good purchase. This could be a true gainer in the long run. But if you are only a long-term investor, if you're looking at cashing in after a year, probably that's you might want to look at a different industry. In conclusion, TD Bank is not a bad purchase. It is a growing, expanding, stable company. Ever the company goes into certain chaotic financial situation, I can only imagine that the government will come in as what it did with Air Canada because of the hugeness. It's huge. The government cannot allow such bank or such organization to fail because many millions and millions of Canadians will be affected by it. So I guess that is the consolation to it. At $66.16 per share, this stock price is closer to the value or the intrinsic value of TD Bank as when compared to Royal Bank of Canada. There you go. Thank you very much indeed. And I hope that you also learned. If you did, please like, share, and subscribe. And I shall see you in the next video.